Hello, in this class, we'll be talking about absorption costing versus variable costing. And before we touch this topic in specific, let's talk about the differences between costs and costing. Those are the two terms we hear a lot in business classes, but not many people actually thought about it. So I think it's worthwhile. Let's look into this issue and figure out what the costs are and what costing is. When we talk about costs in daily life, when we talk about the cost of something, we might refer to how much money we paid for it. If you think about it, it refers to the economic resource in the form of dollar amount that we committed to get that item. And sometimes if you swap or if you work to get that, you're also referring to the resources you committed in exchange for the resource you wanted, or you're talking about the economic resource, which is your labor that you committed to obtain the item. So for business, for financial reporting, we have dollar value rules. And what is this rule referring to? Basically, when we run the company, when we look at a business, the cash, different assets, accounts receivable, inventory, long-term assets like PPE, like intangible assets, land, those are the economic resources the company possesses. And they use those resources to generate income, cash flow for the company to maximize the benefits of the shareholders. So when we talk about costs, we are in business sense, we are really referring to the economic resources firms give up in exchange or to generate some new assets. That's the costs we are talking about. And for example, while direct material, direct labor is very easy to see why they are costs, because you have to pay for direct material, and people use workers use direct material to make products. Meanwhile, companies have to pay the workers by the hours they committed to make the products. So when they pay, because they have to pay, this is also economic resources committed and measured in dollar amounts. On the other hand, company also, to keep the business, company also have to pay rent, and their machines will have depreciation because it's being used, and something other things like that. So overall, those are the economic resources committed by the business to engage in certain opportunities and to obtain certain assets, or in our context, produce certain products. And if you look at the costs, we can also put a cost based on the costs pattern. When the drivers or output changes, we also categorize costs as variable costs versus fixed costs. For example, direct material, direct labor, they are obviously variable costs, and some fixed costs are overheads, or overhead. Some of the overhead are fixed costs, and some other overhead might be variable costs. Now, when we talk about costing refers to the methods businesses use to identify the costs of certain activities, assets, or products. So let's look at this equation again. Here, the whole total equation refers to a costing method. We decompose total costs into variable costs and fixed costs, like we talked about, based on whether the cost varies with output or other drivers or not. And we can also decompose total costs into direct material, direct labor, and overhead, based on what? Based on whether those costs can be pinpointed to each product. Like we said, 2 pounds of plastic make a chair, and 10 minutes for work to make a chair. So those can be pinpointed to each product. Well, for the other costs, which are related to production, directly related to production, but cannot be pinpointed to products, we call them overhead. And an overhead might be variable or not variable. For example, electricity for machine, for the assembly line. It might vary with the machine time. How long you run the machine will determine how much electricity it will be. So it is variable, although not directly variable with the products, but it varies with machine hours. And some other overhead, they are fixed. For example, rent. We talk about the rent again and again. rent, as long as you have the place fixed, no matter how, as long as you have the place fixed, no matter how good you are doing or how bad you are doing, that's gonna be fixed cost because the rent will be fixed. And so if you look at this, especially let's look at the total costs equals the variable costs and fixed costs. Some people are thinking, they're thinking that, okay, of those costs, if we want to identify how costs affects net income, it's kind of troubling because while variable costs are very easy to be pinpointed to, fixed costs, they don't really vary with output or any drivers. They are just those expenses for the same amount happening again and again each month, each week, every year. So when we are doing financial reporting, overall, generally speaking, because both variable costs and fixed costs, they are related to products. Technically speaking, those products, when they were, those costs committed, when they were in the form of finished goods, and some are sold, some are not sold. For those not sold, companies kept them on their balance sheet as their assets. So some fixed costs committed to make those products will remain in the balance sheet and not be expensed because they are not sold yet. They are not committed to obtain revenue yet. And some fixed costs that are contained in the finished goods sold, they are actually committed. So they become part of the costs of goods sold. So that's one way to look at it. And other people, they are saying that, okay, it makes sense, but it is too much trouble. No matter what we do, no matter how many products we sell, no matter how many products we make, those fixed costs will be there same amounts every period. So why don't we bother so much? And then we talk about the contribution margin, obviously only considering variable costs in the costing equation has its benefits as well. Because variable costs versus price give you a very straightforward idea regarding the contribution margin. So why don't we treat fixed costs like those period expenses, for example, SG&A expenses? GAAP requires all the SG&A expenses to be reported on a cash basis, meaning that whenever you pay, it's just expense. You don't have to distinguish. So some people have the idea that, yes, we got it. When you report to outsiders, we want it to be accurate. Because no matter it's fixed or variable, those expenses and resources are committed to make products. And for all the products produced, for those that are not sold, they should stay in balance sheet. They are not committed yet. And the fixed costs contained in those unsold products are not committed yet. So they should not be part of the cost of goods sold. We understand it. But for internal reporting, can we do something only considering variable costs to be the production costs? And because fixed costs are the same amount every period, we just use fixed costs like SG&A expense and other things, period expense, and don't bother to identify, hey, how much fixed costs were sold, were product costs, how much fixed costs stay in the balance sheet. So again, like I said, for external reporting, which is under generally accepted accounting principles, costs, product costs, cost of sold, has to consider fixed costs, has to consider how much fixed costs were stayed in the products unsold, how much fixed costs were not sold. On the other hand, managerial accounting is more flexible and there's no rules whatsoever regarding what companies can do regarding managerial accounting or not. So many companies actually use variable costing method. What is variable costing method? Variable costing method basically means companies would only consider variable costs to be part of product costs, while fixed expense, fixed costs, no matter it's related to production or not, they report it as period expense or treat them as if they are not related to production. So this is variable costing. And the method we talked that used for GAAP, generally accepted accounting principles, we call it absorption costing. What is absorption costing? Because both variable costs and fixed costs were absorbed, used to determine production costs. So here's the income statement under absorption costing and variable costing. On the left-hand side is absorption costing, and you notice that it's very familiar. Well, it looks just like the financial accounting we learned already. Starts from sales revenue and less cost of goods sold, COGS, which will give you gross margin, and then you less selling and administration expense, or selling general and administration expense give you operating profit. And here, selling and admin expenses, they are the period costs we refer to. On the other hand, for internal reporting reasons, on the right-hand side, you can see variable cost in constant format, again, which is for internal use and not formal, not consistent with the requirement of generally accepted accounting principles. It's the same, starts with sales revenue, because we indeed want to know how much companies receive. And the less variable costs, the less variable COGS, which is variable costs we talked about, and instead of fixed costs, this method distinguished between variable selling and administration expenses and fixed selling and administration expenses. So both cost of goods sold and variable part of selling and administration expenses were subtracted from sales revenue, give us the contribution margin for the business. And after that, the company just less fixed manufacturing costs, fixed expense, fixed costs we talked about, and fixed selling and admin expenses, which give us operating profit. So here, some people may ask, okay, it seems they just put different things into different places, and seems they don't really affect operating profit. Is it true? And we can think about it. So for example, right, let's talk about this. So for example, companies spend $100 to make products. And of the products made, they spend $100 to make 100 units of products. And they sold the 100 units of products. Let me give something else. So let's say there's a product. The product is $1 variable costs each. And for the fixed cost of product costs, it's going to be 100 bucks, right? So the company made 1,000 units and sold 80% by the end of the year. So under absorption costing, what's the total cost of products sold? $1 for one variable rate for 1,000 units give you 1,000 bucks, and a 100 bucks fixed expense. And so it's 1,100. And 1,100, 80% were sold, 20% were unsold. So the 80% sold really kicks into income statement, becomes cost of goods sold. So the COGS here we are talking about is 80% of 1,100, which is 880. However, if you use variable costing, and we know the variable costs of the COGS is going to be 1,000 for the 1,000 units. And of the variable costs, only 80% were sold. So the 80% is 800 of the variable parts. So here we only take 800 of the variable, which should be fine. However, on the other hand, you can see less fixed manufacturing expense. How much fixed manufacturing expense we talked about? There were 100. So if we follow this pattern, we know that we actually deducted, manufacturing-wise, we deducted 900 bucks instead of 880. So under this scenario, the costing will be different. The operating profit will be different. And we can take some further look, get some insights by looking at the practices. Managerial Corp has the following data in the recent year. Units in beginning inventory is 0, units produced 1,200, units sold 250 per unit is 9,000. And the variable cost per unit, direct material 70, direct labor 120, variable overhead 80. So we almost got everything we want, right? And the fixed overhead per unit produced was 35, and the fixed selling and administrative expense was 80,000. So here, let's distinguish, all right? I'm gonna do both absorption and variable. it's important for us to have a clean format so we can know what happened and what to do and won't get lost. If your format is really messy, I mean, at least for accounting, you won't go too far in this business. So first, let's talk about revenue. Revenue is the same under both methods. So let me add some stuff. So here we add revenue per unit. So revenue per unit, revenue is the price and the units. So 250 250 is a price per unit, and units sold were 9,000. And now let's talk about costs. Ooh. Variable. Okay, let's not put it like this. Direct material, direct labor, and variable overheads, and fixed overhead. Here, the good thing is kind of, although fixed overhead doesn't change, you know, it's like that you make more, but we do have fixed overhead per unit produced here. And what's the point? Because if for the fixed overhead, for the lease, for the same rent, if you make more units, the fixed overhead allocated to each unit is lower. If you make fewer, the fixed overhead allocated to each unit is of course higher, because fixed overhead itself has to stay the same, the total fixed overhead. So direct material, it is 70 bucks per unit. And the direct labor is 120 per unit. And the variable overhead is 80 bucks per unit. And given the produced amount, which is 12,000, and we know that the fixed overhead per unit is 35. And fixed selling and administrative expense is here, it's 80,000 on the both. It's not a per unit. Pay attention to this. Oh, what am I doing? So let's first talk about absorption costing, okay? For absorption costing, there's one term, as we can go back to see, there's one term called FOGS. And the FOGS has to be determined between the units sold and the units not sold. The cost of goods sold, it depends on how many were sold. So let's figure out how to calculate this. Direct material refers to the products produced, and the direct labor refers to the unit, the labor committed for each unit. So when we talk about FOGS, we are actually referring to the units sold. So again, it's 9,000. And the variable overhead, we know it's 9,000 as well. And a fixed overhead is 9,000. And I will be talking about why. Oops. So for absorption costing, like we talked about, absorption costing consider everything related to production as part of the product costs. So when we are calculating for those unsold, even for the fixed expense portion, they'll be capitalized in the inventory part, which will retain in company's income statement, and which is the reason why they won't be part of FOGS. So for under absorption costing, we know the revenue under both is actually and a direct material, direct labor, fixed overhead, variable overhead. We have all these. done in a similar manner. And let's take a look, right? Fixed costs were committed actually to make products. So they made 12,000 products. That's a total fixed cost. But under absorption costing, product cost includes both fixed costs and variable costs. And the COGS, cost goods sold, by definition, only calculates those portions that were sold as cost goods sold. So we know that it's when we talk about $35 per unit of fixed overhead, it's actually based on the total overhead expense divided by 12,000. That's how many were sold, how many were produced. But when we want to calculate how much work will be sold, it's only for the 9,000 units. So still we do 35 multiplied with 9,000. And then we have setting general and administrative expense, which is here. So if we take a look, operating profits, which we know will be revenue, subtract direct material, direct labor, variable overhead, fixed overhead, applied to the sold part, and subtract 80,000, which is why the business doesn't look good, because obviously they are losing money. And for variable costing, now we do it a little bit differently. Well, these stuff are the same. Oops, sorry. I'll just do it again. I have to. While price, direct labor, direct material, and the variable overhead, they are the same. For fixed overhead, we do it a little bit differently. Am I making a mistake? Ah, that's why. The multiplication. For fixed overhead, like I said, under variable costing, only variable costs are considered to be part of production costs, and fixed costs are considered to be period expense. What do we mean by period expense? It means that you don't have to distinguish between how much, because they are not a part of the product cost. Also, we consider those costs to happen during the period, and they will all kick into income statement. So here, the fixed overhead, what is treated as period expense, what we are saying is here, fixed overhead kicks into income statement will be a multiplication of 35. And how much total overhead again? With the total fixed overhead should be the multiplication of 35 bucks multiplied with 12,000. That's how many were produced. And so if we take a look at this, we can see that the net operating profit equals to 680, which made it worse. All right. So I would encourage everybody to just try to figure out the association between those numbers. Okay. So the question here is calculate any inventory and a per unit product cost using absorption costing. What is absorption costing again? It is here. All right. So let's take a look at absorption costing. First, the ending inventory. Beginning balance is 0 inventory, and then they produced 12,000. We add, and then they sold. Oops. And then they sold, which will reduce even. Which will reduce the inventory amounts. They sold 9,000 units. So how many units are left? And it's not too difficult to see. It's going to be 3,000, which is 0 plus 12,000 subtract 9,000, which gives us 3,000. So of A, B, C, D, we know B and C, B and D, they are probably right. And now let's take a look at a per unit product cost use absorption costing. And for absorption costing, it's really easy because we treat fixed costs as part of the expense, as part of the product costs. And so each per unit costs becomes automatically, if you add them together, so per unit cost will include the direct material, direct labor, variable overhead, and fixed overhead. So if you add them together, what can we get? We have 305. So the answer is B, 3,000 units, 305. So let's take a look at another one. Inventory valuation under absorption costing. The Mian company produced 20,000 units during its first year of operation and sold 18,900 at $17 per unit. The company chose practical activity at 20,000 units. To compute its predetermined overhead, manufacturing costs are as follows. Direct material, 80,000, direct labor, 101,400. Variable overhead rates, 15,600, fixed overhead, 54,600. Calculate the unit cost for each of these four costs and round your answers to the nearest cent. So we make a new sheet. We know for this company, direct material, direct labor, variable overheads, fixed overheads. And what's happening here is those are total costs, not per unit costs. So we need to distinguish this from the name. And the variable overhead is 80,000. I'll make it larger. Sorry about that. Always forgot. Variable overhead is, direct material is 80,000. Direct labor is 101,400. Variable overhead 15,600. And the fixed overhead total is 54,600. Keeping, what am I doing? So please keep in mind that for fixed overhead, we have a total amounts, although they don't change over the period, but we can still allocate them to each product produced. The only thing is the more product produced, the lower per unit of fixed overhead each unit will have. You divide the same thing by more bigger numbers, the result is smaller. Just simple as that. And now let's talk about it. And those material, labor, variable overhead, fixed overhead, they were committed to make stuff, right? To make products. And how many products did they make? How many products did they make? 8. So they made 20,000. 20,000 units. Okay, so here we have per unit cost. Per unit cost will be simply, you can get it by dividing the corresponding total costs by 20,000. So here, for example, there are direct material 80,000 for 20,000 units produced. Each unit is $4. And following the same manner, we know it's rounded to the nearest cent. So, okay. So we're gonna need some better rounding here. And here's for direct labor, variable overhead, and fixed overhead. That's per unit, okay? So we have the first question answered. Calculate the cost of 1 unit product under absorption costing. So here's easy, right? We have everything components already. All we need to do is add them up. So each product under absorption costing will be $12.58. That's the cost per unit. And the third question, how many units in any inventory? So we began with 0 in its first year, right? 20,000 units in first year. It's first year, so of course beginning balance is there. They have nothing yet. Then they produced 20,000, sold 18,900. So where that left us to be, ending finished goods. It's gonna be 0, which is beginning balance of inventory, plus 20,000, which is produced, subtract numbers sold, which is removed from the warehouse inventory account. So there are 1,100 units left. So these 1,100 units, their cost is gonna be the same, $12.58. So the end inventory value would be 1,100 multiplied with per unit cost, give us $13,838. So here we just talk about the general differences between absorption costing and the variable costing. To me, we would need to think about is on the different income situation when companies are doing good versus not doing good. And when company, we can tackle from here, if companies sell more than they produce versus companies sell fewer than they produce, how is it going to change the association between the difference in operating profit under absorption costing method and variable costing method? Please think about it. We can factor in different numbers to see the trend, or you can just use some hardcore mathematics represents, for example, numbers units sold as X and units produced as Y, or the other way, and to see whether this relationship, income association, would change or not. Okay, that's all for this class talking about costing methods. See you next time.